Most retirement tax mistakes don't feel like mistakes when you're making them. There's no warning email from the IRS. No pop-up saying, "Careful. This move is about to cost you thousands." Everything looks normal. You take money out to pay your bills, enjoy retirement, and move on with life. Then, months later, your tax return tells a very different story. Somehow, a $40,000 withdrawal turns into more than $70,000 of taxable income. That's not a math error. It's a sequencing problem. This happens all the time to retirees who have a mix of income sources, usually a 401k or IRA, Social Security, and a pension. Each one works fine on its own. The trouble starts when they overlap. The tax code wasn't designed to look at your income as a whole. It treats each stream separately, and the interaction creates hidden traps that don't show up until it's too late to undo them. The key issue isn't how much money you're spending. It's the order in which your income shows up on your tax return. Think of retirement taxes like pressure points. Below certain income levels, nothing happens. Cross a line, sometimes by a very small amount, and new taxes suddenly turn on. More of your Social Security becomes taxable. Medicare premiums jump. Extra surtaxes appear. None of this feels connected in the moment, but it all traces back to sequencing. To understand why this happens, you have to look at how each income source behaves. Money coming from a traditional 401k or IRA is taxed as ordinary income. Every dollar you withdraw increases your adjusted gross income. That matters because it doesn't just affect your tax bracket. It affects what happens to everything else tied to your income. Before required minimum distributions begin in your 70 seconds, you have flexibility. After that, the IRS forces withdrawals whether you need the money or not, which makes early planning far more valuable. Social Security follows a completely different set of rules. You can claim as early as age 62, but doing so permanently reduces your benefit. Waiting until full retirement age, or even better, age 70, results in a much larger inflation-adjusted check for life. But whether your Social Security is taxed has nothing to do with the size of that check. It depends on something called combined income. Combined income is calculated using your adjusted gross income plus any tax-exempt interest plus half of your Social Security benefits. For married couples, once that number passes $44,000, up to 85% of Social Security becomes taxable. Those thresholds were set decades ago and never adjusted for inflation, which is why more retirees fall into them every year. Pensions add another layer. They provide stability and peace of mind, but they also reduce flexibility. Pension income is usually taxed as ordinary income and stacks directly on top of your other income. When a pension starts automatically, it can force income into your plan earlier than expected, increasing the risk of overlap. Here's how the damage happens. A couple receives $42,000 in Social Security and $18,000 from a pension. Before touching their IRA, they're just under a key tax threshold. Then they withdraw $40,000 from their IRA to cover the year. That single decision doesn't just add $40,000 to their taxes. It pulls roughly $36,000 of Social Security onto the tax return as taxable income. The result is more than $70,000 as taxable income created by one withdrawal. This is often called the Social Security tax torpedo, and most people never see it coming. On top of that, income spikes can trigger higher Medicare premiums 2 years later through IRMAA surcharges. For some retirees, investment income may also be hit with the 3.8% net investment income tax once certain thresholds are crossed. This is why the common advice to delay your 401k and take Social Security early often backfires. It ignores how the tax rules interact once multiple income sources are turned on. A more effective approach focuses on control early and guarantees later. Many retirees benefit from using flexible income sources first, strategic 401k, withdrawals, brokerage assets, and Roth conversions, while tax brackets are lower and Social Security is still off. That reduces future forced income and creates tax-free options for later years. When guaranteed income eventually begins, it fills a plan that's already been shaped intentionally instead of colliding with it. The goal isn't to build the lowest tax return possible. The goal is to support the life you want with fewer surprises and more confidence. Retirement income planning isn't a one-time choice. It's an ongoing process. But once you understand sequencing, you stop stepping on invisible tax landmines, and you keep more of what you already earned.